Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Uranium Energy Core.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We're really looking at a company that's at this massive inflection point.
Right. Moving from just holding assets and, trading inventory to becoming a full-on producer.
A fully integrated domestic producer. And that's the key.
And that transition, it's written all over the financial headlines.
Yeah.
If you just look at the top line for fiscal year 2024, Uranium Energy Core reported, $66.84 million in revenue?
Which is, just for context, an almost 30,000% surge from the year before.
An absolutely massive number.
It sounds like, explosive growth, but we have to be really clear about what that number actually represents.
Exactly. That jump wasn't from mines suddenly starting up. It was from them strategically selling off their physical uranium inventories.
They monetize their existing assets. They're essentially funding the future by selling off parts of the past.
And that really explains the other side of the coin, right? The net loss.
The $87.66 million net loss in that same year. And that loss is a very deliberate choice.
It seems so counterintuitive, a 30,000% revenue spike, but the net loss actually doubled.
But if you think of it as a construction period, it all makes sense. They're sinking that money into building out their U.S. and Canadian assets.
So they're using cash today to buy operational leverage for tomorrow.
Precisely. They're in the building phase. That $87 million loss is the cost of concrete and machinery before a single pound of new uranium comes out of the ground.
We did see a pretty encouraging sign in the most recent quarter, Q1 of fiscal 2026.
Right, even with zero revenue reported in that quarter.
Zero revenue, but the JAP net loss narrowed quite a bit. It came in at -2 cents per share.
Which beat the consensus estimate of -4 cents.
And that suggests some pretty disciplined cost control, even while they're still in this pre-production stage.
It's the market's way of seeing management discipline. And that's why the street seems willing to underwrite this whole transition so aggressively.
And they really are. Analysts are projecting break-even profitability is now being pulled forward to 2027.
And if they hit their targets, some models are projecting annual revenue could get to around $244 million.
Which is another, almost 400% jump from here.
Exactly, with non-GAAP EPS hitting 40 cents once everything is scaled up.
So the big takeaway from the financials is you have to look past the current losses.
For sure. The losses are not a sign of failure. They're a sign of investment. You're betting on this transition away from inventory trading and toward real recurring production revenue by 2027.
Okay, so with that vision in mind, how does the company actually position itself?
Yeah.
Let's talk about the strategic mode.
Yeah, because this is where they're really trying to separate themselves from the pack.
This is the real game changer, right?
It is. They are positioning themselves to be the only domestic U.S. supplier that can control the entire fuel cycle.
From mining all the way up to, uranium hexafluoride?
Yeah.
The UF6 conversion.
Exactly. And that conversion step is so critical. For a lot of people, UF6 probably just sounds like jargon.
So why is it the bottleneck?
Because after uranium is mined, it has to be converted into that UF6 gas before it can be enriched for fuel rods.
And right now, a lot of that capacity is controlled by
Geopolitical rivals.
Yeah.
Russia, most notably.
So by setting up their own U.S.-based conversion subsidiary, they're plugging a huge strategic hole for the U.S.
A massive one. They're aiming for a fully American-controlled fuel cycle end-to-end.
Which aligns them perfectly with U.S. energy security goals. That's not just a small advantage, it's a huge tailwind.
It's a multi-billion-dollar structural advantage that goes way beyond just the day-to-day uranium price.
And the assets that are backing this up, they're mostly those in-situ recovery, or ISR, projects.
Right. In Wyoming, South Texas, and up in Saskatchewan. And ISR is generally seen as lower cost and more environmentally friendly.
And that lower cost structure is key.
It's vital. They're using a hub-and-spoke model. The plan is to restart their Wyoming hub by mid-2025, which gives them scalable, low-cost production right next door to their U.S. utility customers.
So you combine that domestic ISR production with domestic UF6 conversion.
And you get a really powerful combination. It reduces dependence on foreign processing, for one.
But it also really raises the switching costs for the utilities, right?
Massively. If you're a U.S. utility, you would much rather sign one long-term contract with a single, secure domestic supplier than juggle multiple contracts across different risky jurisdictions.
It creates a protected niche. Most of their peers are either just miners or traders.
Not both. This integrated platform is, I think, a genuine structural moat.
Okay, so that's the plan. But we have to look at the financial health that's backing this whole thing up.
And this is the key mitigating factor for all that execution risk we're talking about, the balance sheet.
It's clean. They report a debt-free balance sheet, a debt-to-equity ratio of 0.
It's almost unheard of for a company this deep in a capital-heavy building phase.
And they have the cash to back it up,
They do. They're holding about $455 million in cash reserves.
supported by that recent public offering that raised, what, over $200 million?
Right. So total assets are sitting around $698 million.
That $455 million in cash, that is a staggering amount for a company at this stage. But where is that cash going first?
It's earmarked for two main things. Restarting the Wyoming ISR production, which gets them to first revenue.
And building out the new U.S. UF6 conversion facility.
Exactly. The liquidity means they can fund both without needing to take on debt or, dilute shareholders again anytime soon.
But that's the trade-off, isn't it? They have the cash now because they diluted shareholders to get it.
That's the core trade-off.
If they miss those 2025 or 2027 targets, that cash cushion disappears and they have to go back to the market again.
It's the key risk.
Yeah.
For now, though, their negative free cash flow is a very calculated choice. They are reinvesting every single dollar into getting those projects ready.
Okay, so given the big vision and the strong balance sheet, how is the market reacting? What are the charts telling us?
The technical picture is pretty constructive. It's a solid uptrend.
The stock is trading well above its long-term moving average, the 200-day.
Yeah, which is sitting around $9 and acting as a major floor, a big support level.
And the momentum is clearly strong. The RSI has been up around 70 recently, which that's heavy buying.
For sure. But the most telling sign for me is the 50-day moving average is trading above the 200-day.
The Golden Cross formation.
Right. It's a classic bullish signal. It suggests the trend has real momentum and, more importantly, institutional support.
And we definitely see that. There are, 591 institutional funds with reported holdings?
This is not just a retail-driven story. Big money is accumulating shares based on that long-term narrative.
And the sell-side analysts are positive too. We're seeing price targets in the mid to high teens, some even up to $19.
And the options market is skewed heavily toward calls, which again signals confidence in that multi-year growth story.
But we have to ground all this in reality. We need to talk about the risks.
Absolutely. Because they are significant. For anyone holding this, your biggest worry isn't the spot price of uranium next week.
No, it's the cost of concrete and the speed of regulatory approvals.
That is exactly where this whole thesis lives or dies. The bear case is 100% about execution and timing.
Building that UF6 conversion arm is. It's just incredibly complex.
Operationally complex, capital intensive, and it's under intense regulatory scrutiny.
Any misexecution, any delays or cost overruns, and that cash buffer starts to burn a lot faster than expected.
And that's when you could see them forced back to the market for more capital, which means more dilution for existing shareholders.
And we can't forget, they're a pre-cash flow story right now. That last quarter had 0 revenue.
So they're highly sensitive. If uranium prices soften, or if that Wyoming restart slips past that mid-2025 target,
Then the 2027 profitability projection gets pushed out.
it could be significantly delayed.
So what are the key near-term catalysts we should all be watching for over the next, say, 6 to 12 months?
I think you have to be laser-focused on any operational updates about that Wyoming ISR restart. That is the first real step toward recurring revenue.
And the other big one has to be milestones for the UF6 conversion unit.
Absolutely, because that's the geopolitical moat. So we're looking for news on final site selection, regulatory filings.
Or the big one, early offtake agreements.
Yes. A major U.S. utility signing on the dotted line, that would be a huge de-risking event.
And then finally, there's that
Yeah.
sort of speculative upside from government policy.
Right. Given their unique position, they are the most plausible beneficiary if the U.S. government decides to expand strategic uranium purchases or offer other support for domestic producers.
It's pure optionality at this point. You can't really build it into a financial model.
No, but it gives the stock a significant political premium that, say, a miner in Kazakhstan just doesn't have.
So the investment thesis here is pretty straightforward.
Yeah.
You have a company using a fortress balance sheet to build a fully U.S. integrated nuclear fuel platform.
It's a high-growth, high-risk play, and you, as the investor, have to be willing to underwrite several years of really complex execution risk.
The chance that asymmetric upside, once production finally starts to ramp up in 2025 and beyond.
Absolutely. So if you are tracking this stock, you need to focus less on the immediate gap losses and almost entirely on those operational milestones over the next few quarters. That is the only metric that truly matters right now.
Make sure you hit that subscribe button for all our daily stock analysis and catalyst talks right here on Smart Wealth with Joshua.